And welcome into Growth Profits, where today we have a very special guest. I wish he was in studio, but alas, we'll take whatever we can get. We're going to talk to the man himself, who I think is the tax strategist extraordinaire, Mr. Chris Anderson. You're not going to want to miss this, and you're going to want to have a pad and a pen. Stay with us. Hi, folks. I'm Sean Crabtree.
And I'm Cameron Bailey.
You got one shot at this life.
Why would you not make it the best that it can be?
This show comes to you weekly about happier clients, better results, making more money, and enjoying the ride.
Let's get started.
And welcome back. Welcome back to Growth Profits, the show that comes to you every single week. As you know, talking about ways for you to have happier clients, better results, make more money, and enjoy the ride. I am really super excited to have somebody that I personally, in full disclosure, have worked with for what, Chris? Probably this is like year number 4 maybe, or something like that.
Yep,
that you and I have worked together. Chris is an EA, and I'm going to let you tell us a little bit more about what an EA is. But I want to speak from my heart rather than reading this bio, because Chris Anderson is what I call tax strategist that I've been looking for nearly 30 years. And just on a personal note, many of you who are listening to this right now are in the same situation that I was in. You know, for years, I would call my accountant and I would say, hey, I'm about to do this or I'm about to do that. Is there some kind of tax implication, good or bad? And how can we arrange this in a way to minimize my taxes? And for years and years and years, what I heard was, yeah, they're going to get you one way or another. There's really nothing you can do about it. At the end of the day, Sean, you just need to be happy that you're earning more money and be glad that you're paying taxes. And this frustrated me year after year after year after year until I found this man that you're about to hear from. Chris Anderson is the person that I call and say, hey, Chris, I'm about to do such and such. And he'll go, you know what? Let's create a strategy for that. And every single time he will get back with me on here's exactly what it is that you need to do. Chris is an EA, and that stands for an enrolled agent. And I'm going to let him tell you a little bit about that. Chris Anderson, thank you so much for being with us. I appreciate very much you spending the time. You have saved me over the years, I'm guessing nearly $100,000 at least. And in the clients that you and I both work with together, clients that I referred to you, it is not uncommon for you to save my clients $50,000, $60,000, $80,000 in a single filing. And so for this, and I'm going to shut up in just a second and let you talk, but for I want the people who are listening to this, and if you're driving down the road, you're going to want to pull over and have the ability to write, because I'm going to ask Chris some questions, let him tell you exactly some of the things strategically. Of course, your situation is going to be fact dependent, and it's going to be based on what's going on in your scenario. But I'm going to let him tell you how he saved me and my clients a literally tremendous amount of money. There's no way I can thank you enough for all of that. Welcome in, Chris Anderson.
Thanks, Sean, so much. I'm so happy to be here. What I love to do is save people money.
This is obvious.
Yeah. So when I get up in the morning, it's not to plug numbers into a computer. It's how can I help my clients save money and improve their lives? I'm a firm believer that you can spend your money a lot better than the IRS can. I haven't had anyone disagree with that.
That seems to be a universal truth as far as I'm concerned. Yeah.
Also, I like to tell my clients, you work hard for your money, so you should keep it. And so I haven't had anybody dispute that yet either.
Yeah. There you go.
But yeah, thanks so much. I'm going to enjoy this, and I'm going to enjoy sharing some great insights. We're going to get into the meat of things today. We're not going to talk superficial and just kind of prick your interest. We're going to get into the nitty gritty, so I'm going to enjoy that.
I appreciate that. Let me ask you this, Chris, out of the chute. Before we get into so here's I I meant what I said. I mean, for years, I have tried my very best. Thousands of times I have contacted my CPA, and I've gone through several CPAs over the years, and I've asked them, what is the way for me to approach this? And the answer is always the same. There's nothing you can do. Just be happy that you're paying the taxes. You think differently than anybody that I've ever worked with, and this is what I so appreciate about you. How is it that you're thinking that nobody else is thinking, and why is nobody else thinking this way?
I get that question a lot. I think there's several factors that come into it. One is my motivation and drive, like I said, is to save my clients money, not just to turn and burn a tax return and get paid $1.
File the taxes, right?
And so I'm really interested in helping improving people's lives. And so I've sought after, opportunities, education, and things that can help me do that. And that comes back to your question that you touched on. I'm an enrolled agent, not a CPA. That was a very on purpose decision that I made. And so an enrolled agent, we take testing just like a CPA does. So we have to have the same education, same testing. But that we take with the IRS directly, where a CPA will take it on the state level. And that's important for me for two reasons. One, if I take it with the IRS, I can now help clients all over the country rather than having to go state by state. So it opens up my ability to help more people. And then also the enrolled agent is a lot more focused on tax law than the CPA is. Not that CPA in any way is a bad thing, or that, someone shouldn't choose CPA over enrolled agent. But for me, and what I was trying to accomplish with my clients and being able to have the most education, the most knowledge about tax law, the most ability to go in and create strategy, find within the tax code what's available to my clients. And the tax code is 6,000 pages long. And truthfully, there's a lot of don'ts, but most of it is exceptions. And it's learning about those exceptions. It's learning about how these different things play together, and then being able to take them in a practical way and apply them to my clients. And so being an enrolled agent was really important for me to help me create the most value for my clients possible.
Man, I appreciate that explanation. I appreciate that very much. I think that the term EA, I think, is a little confusing for a lot of people. And you and I have talked about this before, but even just hearing it again, I totally appreciate it. At the end of the day, Chris, I don't care what you are. You've saved me a ton of money, and I so appreciate you for it. And there's no way in the world that I could ever thank you enough. So let me ask you this. I know, in me sending some of my clients to you over the years, there are many different strategic approaches that you take, and all of those approaches are very dependent upon what's going on with the client that you're working with, what is their business structure, where the opportunities lie. And by the way, you mentioned the tax code a minute ago being 6,000 pages long. There's some changes to that. If there's some things that maybe down, closer to the end of this interview, if there's some things that you need us to know about that, I'm going to ask you about that in just a second. But if you can, for this scenario, give us a couple. Give me probably the number one biggest mistake that you see entrepreneurs make. And while I know the strategy that you're going to recommend is going to be specific to their situation, there may be some overall things that you can say, hey, here's where you need to be looking at, and here's some of the things that we normally do.
Yeah, absolutely right. Every client is different, even within the same industry. That's one thing we're really good at, is just, getting in and having a lot of conversation before we make any recommendations, so that we make sure we're getting the right strategy for the right person. Having said that, just like you said, there's some general things and some strategies that if you're not aware of that I'm going to bring up here in a minute, definitely should be having some conversations around these. Some may or may not be a fit for you, but all of the ones we bring up today should at least be discussed in your situation.
Okay.
And do you want to just jump right into some of those?
Well, let me give you a scenario. Let's try this, because I'm trying to think, if you're an entrepreneur and you're listening to this at this point, there's some assumptions that I could make, and I want to give you a typical scenario. And this is a typical scenario that I've seen over the last 20 plus years. A typical entrepreneurial scenario that I run into is the owner of the business also is the owner of a building. And in a lot of cases, that business is, let's say, an LLC. And maybe we should talk about what an LLC is and some of those kinds of things for if you're listening in. But this was a particular eye opener for me in a lot of different ways, and there's a couple of different angles that you can go on this. But if I'm an entrepreneur, I own my business, and I own my building, there's some things I should know about that in terms of how I pay, because most people are thinking I have my business pay me rent, but of course that's taxable income, right?
Right. Yeah, no, that's a great question. That's very, very common. And this is one of the things that surprises me the most, that a lot of people don't have conversations around. But if you're a business owner and you also own your building, you're right. There are some ways we need to look at structuring that LLCs and different things. And we can kind of get down into that. But one of the most important things that I want to talk about is if you own a building, a commercial building that you run your practice out of, or business, then there's a strategy called cost segregation. And it's a really, really powerful. I save, my clients tens of thousands of dollars, even in the first year, by utilizing this strategy. And what it is when you buy a commercial building, you have to depreciate that over 39 years. This means you take the purchase price and you take a slice of it, 1/39th a year for 39 years.
For 39 years.
So, which is all fine and good. That's a depreciation deduction you get to take against the rental income you pay yourself. It's not a bad thing. But what cost segregation does, it allows us to come in and we take that building and we break it up into different components. We break it up into the plumbing, to the electrical, to carpets, to doors, to windows, and all these different things. And so we are still going to end up with a chunk of the building that's still 39 years, but then we're going to get a chunk of the building that we can depreciate in 5 years, 7 years, 10 years, 15 years, and 20 years. And so, and if it's the first year you're buying a building, we can get some bonus depreciation going on in there. And man, it's great. I had a client that every single year, he's a great client, made good money, but he literally gave all of his profit away to taxes every single year.
Wow.
So we implemented this and a few other strategies. And that first year, he paid zero taxes legally.
Wow.
And just totally turned his life, his business around. And so cost segregation was a big part of that.
Well, this is one of the things that I was hoping years ago when you and I were working together. That was not a strategy that fit for me, and I was hoping that it was. But you and I have a client that we both have worked with, and when you first started working with him, if I'm not mistaken, that was almost a $65,000 net take-home increase for him, strictly in that one strategy. That was a life changer in that situation. And again, as we keep saying, a lot of this is fact specific based on your situation. That's one of the things that didn't work for me, but it does for almost all of my clientele, which is great. It just didn't work for me in my situation. So that was a really good one, and I'd like to throw. I think that's a good strategy, and it's a good example of something that we run into in terms of entrepreneurs all the time, right?
Right.
And I don't want to. Chris, you're the expert. I'm not the expert, okay? But there are a lot of opportunities. You mentioned an LLC. There are a lot of opportunities. I don't know if that's a strategy. Maybe you think that's too much in the weeds for this conversation. I don't know. But there are a lot of opportunities in terms of the different corporate structures, LLC, S Corp, C Corp, different things like that an entrepreneur really needs to understand. Am I right?
Absolutely right. What I run into a lot between clients and even other accountants is they try and pigeonhole everybody into one type of entity, whether it's an S Corp, an LLC, a C corporation, as well as pigeonhole them into the state that they live in. And so, like I said, everybody's a little bit different. And these types of entities, none of them are good or bad in and of themselves. They have different characteristics under the tax law. And so depending on your situation, we may utilize one entity over another. We may do a combination. In your situation, we're using several different types. And the reason is they're taxed differently. And different tax rates apply. And so when we can go into an individual, an entrepreneur situation and look at everything they're doing, not just their one main business, we can then bring different structures and different entities into play that's going to save them a significant amount of taxes.
Awesome. And so, like you said, there's no good or bad with any of those, but it's really making sure that you have the right corporation laid out for tax strategies and what it is that you're trying to accomplish.
Yeah.
So I'm curious if just to run with us a little bit. You mentioned cost segregation, which is a big one. And you didn't get into the weeds on the different corporate structures, but there's a lot of strategies within how you lay those things out that I don't know about, that you educate me on almost yearly every time we're talking through those. What are some other things that you see if I'm an entrepreneur? Let's say, Chris, that I am a 30-something entrepreneur. I'm a couple of 3 or 4 years into my entrepreneurial business. I am living my dream. I am making money that I didn't, anticipate being able to make. And frankly, I'm not even thinking about taxes at this moment. I'm thinking about, hey, I'm making a good living. What are some things that you need to warn me about?
Yeah, absolutely. That's a great question, because there's so many people in that situation, and all of a sudden April 15th comes along and their account hands them a big tax bill, and then all of a sudden they're like, holy crap, I got to pay attention to this.
Right.
One of the things that I love helping people that have been paying taxes for a while, but I really love helping the guys out the gate really get a jump start on their business as they start to make money. And some of the things that especially 30 something, a couple of great things really to think about. One is paying your kids. This is one that most entrepreneurs don't utilize, but it's available to all entrepreneurs. And obviously, everything's shadowed with, your specific situation. You have to do things in the right way. But paying your kids is really great. And with the new tax law, so in 2017, you can pay your kids up to $6,300. The kids wouldn't pay any taxes. They wouldn't pay federal, state, Social Security, or Medicare. No taxes at all. And then you can write it off 100% as a business. Obviously, it's got to be structured right. I'll get into some of those details for you here in just a minute. But with the new tax law changed, that upped to over $12,000 a year per child you can pay your kids.
Really?
And so what people joke about all the time is, things that they have to pay for their kids. Hey, can I write that off? Well, this now becomes a way to inadvertently pay for things that your kids are doing. So we're going to pay your kids. Now your kids pay for the extracurricular activities, all of their extra stuff, their clothes, food, whatever. It doesn't have to be spent on that, but it is a way that we can get some tax-free dollars to utilize for whatever you need to.
Okay, now this is big. Let me tell you why this is big for me. And by the way, you threw something at me there I didn't know. I thought it was still a little over 6,000. So it's 12,000 now. Okay, that's great. So what I tried to do when you introduced this concept to me several years ago, and of course I do pay my daughter and I have her work. I mean, she works for that, obviously. I'm not trying to pull anything. It's the real deal. But there's also a lot of value in that because I made her get her own checking account, right? She now has to look at some of that. And when there are things that she wants to do, we're able to have a conversation about what does your account look like? And so she began learning about money at a very, very young age, much younger than I did. And I wish I had had that opportunity. She understands how checks work now. She understands the concept of money. She's not nearly where she should be. Don't get me wrong, but it's given us a real opportunity to have her become responsible in ways that I never probably would have taken the time to do if I hadn't been introduced to this concept by you several years ago. And now she's about to turn 15. So she's getting to the point where, a car is going to be important sometime. So now she's taken, we're going all the way to the nth degree on this. We've got spending money. We've got giving money, right? We've got saving money. And I was able to take this conversation to a much higher level with her. And there's things that she's saving for. There's things that she gives for. And then there are things that she spends for. This is a concept that I think this is a win all the way around. This has been a big life changer for us. So I just want to say that this has been huge.
Yeah, I really appreciate you bringing that up, because often with our strategies, things are layered. Yes, we're trying to save taxes, but the opportunities that these strategies create are pretty powerful as well. And that bring that up with your daughter is amazing. You get to be able to teach her things that you wouldn't have otherwise, and those are
I wouldn't have
valuable.
taken the time at the end of the day. I probably would not.
Yeah, and we're all that way, right?
Right.
So, but now, not also are you learning that, but you're teaching her with tax-free dollars. So it's money you didn't have to pay taxes on, and she gets all those life lessons. And a couple things just to, I hope we're getting some people excited with this conversation, but just a couple nitty gritties of, you can't just throw 12 grand at your kid and write it. Right. So like you said, your daughter works, she actually does something, and that's a benefit too, right? It's teaching her work ethic. It's teaching her that you do some service and you get paid a good wage for it. And hopefully that'll carry throughout the rest of her life. But your children do have to do something. Now we can get a little creative in what that is. There's physical things that they can do, obviously, that you're doing around the office, helping with different things. As they get older, they can do more things, obviously, than when they're little kids. But you can also utilize them as models. Most, if not all entrepreneurs, if not, you probably should be doing this. Websites, Facebook, LinkedIn, podcasts, blogs.
Yeah.
Around your office, dentists, they're taking pictures of patients' mouths all the time. Why not it be your kid's mouth? Doing videos and different things on how to do procedures, how you help children feel comfortable. Do a video on it with your own child, put it on your website.
Great ideas.
So all these things, and that can help with so little kids who necessarily can't do a whole lot, even babies as they're, whatever you're in. I have a lot of clients in the essential oil industry, and the essential oils applying them to kids is a lot different than adults. And so they do videos on how to dilute the oils and apply them to the kids, and now they can pay their kids for being models. And so you can really get creative, but we do have to have a reason for paying them. And so it's important too to have a good account that you can bounce those ideas off of and talk through the scenario of how can I make this work. And again, not trying to do something hokey, but do something legitimate, within the law. But the law is there to allow us to do
Well,
this.
but I think, and that's the thing. I mean, I think most entrepreneurs try to get their kids involved, and so they're probably doing it anyway. But they don't understand the creative way to be able to have that benefit them, and in this scenario, benefit the kids along the way. That's a really good point. So I didn't mean to interrupt you, and you were going with a couple of good things there. So if I am we're talking about a 30-something. Let me give you a different scenario. If I am a 50-something, and let's say my scenario, hard to believe I'm a 50-something, Mr. Producer. What are you thinking? Yeah? You think I'm like 28, right? So
I was going to go 27.
27, yeah. If I'm a 50-something and I'm listening to this and I fall into the category that Sean just mentioned, where I feel like I've wasted a lot of my time not paying attention because I didn't have the right tax strategist along the way, and I've wasted a lot of money that could have been maybe to my benefit. And now I'm inching closer toward looking at the sunset of my career, or something like that. What are some things that I should be concerned about?
Yeah, that's a great question. That's more common than not, right? Most people,
Unfortunately, yeah.
they're working hard, they're earning money, paying taxes. All of a sudden, they're 50-something. They're like, holy cow, okay, how much longer do I want to be doing this? How much longer do I feel like I have to be doing this? One of the things that I love to do is give my clients options. And so a 50-something, I want them to get them into a place, if they're not already there, most aren't, to be able to say, hey, if I want to do this for 20, 25 more years, great. If that's what you want, let's get you doing that. But if you're like, you know what, I'd really like to maybe put another good 10 years in, 15 years in, but then, have the opportunity to do less, or go sit on a beach, or go do service, whatever it is that they want. And that's what I love doing, is finding out what the client wants and helping them get that. Not necessarily pushing them down a path because that's the only thing I know. And so a 50-something-year-old, one of the first things that I really look at is a strategy called the 831B strategy. And this is an opportunity not just for 50-something-year-olds, but it really fits them, particularly because they've got enough years in their business. They're usually making more money than the 30-something-year-olds.
Mm-hmm.
They're also paying a lot more taxes.
Mm-hmm.
And what this 831B, it's the name of a tax code, kind of like a 401k is the name of a tax code, or S selection is the name of a tax code. So 831B is the name of the tax code, but it's a vehicle within the tax code that allows us to put massive amounts of money in tax-free bucket with one limitation of the needs to stay in that bucket for 12 months. Then after that, we can utilize it for whatever we want. A lot of people will create this as a tax-free kind of bank on yourself concept, so they don't have to use banks anymore. It's going to be part of a retirement plan. It's going to be part of getting just excess income off your tax returns, so you don't have to pay taxes on it. There's some tax implications down the road, but they're a lot less, taxed at a much less rate than they are up front. And so it's just the best.
So essentially, you're parking money. You're parking money for a designated period of time, but you're able to do it tax-free or maybe tax-deferred.
Correct. Tax. We don't always have to pay taxes on it, but the worst case scenario is you'll pay the capital gains rate rather than ordinary rates. So you get an ordinary, so you could be maybe at your 35% ordinary tax bracket. You get that tax deduction. Worst case scenario, when we utilize it, you're paying 15% capital gains deduction. Maybe 20, but the way we structure it, usually about 15%. But that's an if. There's other ways to utilize it where we may not have to do that capital gain. So the worst scenario, we're saving that spread in between, and we're saving it, for a period of time, so that you're not just giving it all your profits away to the government.
Right. That's huge, man. That's huge.
And so someone like that, you're typically looking at, you need to have about 40,000 excess cash. Mm-hmm. You're looking at your taxable income is typically around 250 to 300,000 or higher. Mm-hmm. And then you need to be able to, I say excess cash because that 40,000, it's going to be tied up for 12 months.
You're parking it, right?
Yeah, you're parking it for 12 months. And so it's similar to some of the benefits of a 401k, right? Where you're parking it, but it has none of the baggage that a 401k does. You don't have, that's parked until you're 59 and a half, no matter how old you are. If you want to utilize it before then, you get penalized. You get very restricted on what you can do with that money. Right. Where this, we can put as much, up to 15% of your gross. So if your gross is $1 million, you can put up to 150,000 in it. And it's there to use for whatever you want in 12 months, which is huge. If you need a new piece of equipment, if you need money to hire employees,
Wow.
You just want to take the money out to buy a boat and go spend more time on, Lake Michigan or wherever you're at. We just, it's just a powerful, powerful strategy. And our 50-year-olds are usually almost always a candidate for it. And it can really accelerate their financial goals, their wealth planning, and especially if they're feeling like they're behind, that they haven't really done much. This strategy will get them caught up pretty quickly.
Wow, 831B strategy. That's awesome. Let me ask you this. You mentioned a little bit about just in that explanation of that strategy. Just for my own curiosity, has the capital gains rate changed in some of the new changes, or no? Has it?
It changed a little bit. It didn't get higher. What it did is it used to have 3 brackets, 10, 15, or 20, and then depending how much income you made.
So explain to us, if I'm listening to this and I don't even know what a capital gains tax is, explain to us what ordinary versus capital gains is in a typical scenario.
Yep. So an ordinary is just if you're providing a service or selling a product, you're creating ordinary income, and you have ordinary tax rates on it.
Right.
And so capital gains, the most common capital gains, if you buy and sell stocks in the stock market, you buy a piece of real estate, you sell it, those they're considered passive incomes. are going to create a capital gain, more investment type income and things like that. And so this 831B strategy changes the ordinary into a capital gains, which is just phenomenal.
And so if I buy a piece of property, is there still a 2-year turnaround on capital gains, or how does that work? If I keep it
Yeah, I'm glad you asked that. So there's two types of capital gains. There's short-term and long-term.
Okay.
Short-term is any passive activity you do, like buying a piece of real estate that you do within a year. And those capital gains rates, short-term, is taxed at the same rate as ordinary.
So that would be the highest form of capital gains.
Yeah. And so long-term is anything that you've held for a year and a day or longer. And so if you've got a piece of real estate and you're wanting to turn around and sell it within a year and you're within a couple weeks, wait a couple weeks and get past that year and a day.
So even if I hold, if I were to buy a second home and I hold that for 4 years, I'm still going to pay capital gains, but it would be at a lower rate.
Correct.
Really?
Yeah.
So 2 years, 4 years, doesn't really matter, same rate.
Correct.
I did not know that.
A year, a day, or longer.
Okay. All right. That's interesting. That's good to know.
And just as a tidbit, people haven't, it's related but a little bit off track, but your personal residence, up through 2018, if you lived out 2 out of 5 years, you had an exemption of, if you're married, $500,000 of profit you could not have to pay tax on. That has now changed starting in 2019. You have to live in it 5 out of 8 years. So a big difference. So if you're thinking about selling your personal home, keep that in mind.
But same rate, same dollar, just longer years?
Right. It'd still be a long-term capital. Yeah, same dollars, correct. 500,000.
500,000. Okay.
Married. 250,000 if you're not married.
Wow. Okay. Wow. That's really good to know. Okay. Let me ask you this. So we talked about the 30-something, we talked about the 50-something. What if I'm middle of the road, Chris? What are some things that I need to know? I'm late 30s. I'm middle 40s. You know, I'm to that point where I've got kids that are perhaps entering college or close to being done. You know, I've got mortgages that I'm looking at being done with, and I'm starting to shift toward the looking at the 50-something stage. What are some things that I need to be concerned about?
You know, one of the first things, now everything we've talked about so far could apply to any age group, but I love the way you're approaching it and saying, okay, for this particular age group, what is maybe the most important thing you want to look at first? Right. And so the middle of the road, especially ones where you've got, kids starting to go off to college and things like that. What's unfortunate is as your income goes up, the government thinks that you're able to pay more and not get as many good credits and things. And so, there's great credits for college, for example, right? So if kids are going to college, there's the American Opportunity Credit, there's a Lifetime Learning Credit, different things that can help compensate and pay for some of those things. Well, if you're making too much, sorry, you don't get those credits. And usually, entrepreneurs, their 20s, they've made all their mistakes. The 30s, they made up for their mistakes. Now in the 40s, they're starting to make some real money, right? And so now they start losing those credits and things right as they're starting to come into play. Well, this is a great example of going back to paying your kids. You can pay your kids. They'll pay their own tuition. They'll file a tax return independently, so they're not going to be dependent on your tax return anymore, which is okay because you don't get the credit anymore. Right. So zero impact on your tax return.
Wow.
Now they file, you got to write off what you paid them, plus they get all the education credits because they're filing their own return claiming themselves. Yeah.
Man, that's huge. That's big. So I'm essentially still I'm paying them tax free, and they're paying their tuition and so forth. Wow.
So once the kids turn 18, they do have to start paying taxes. Okay. But the education credits, if it's done right, will pay for their taxes, plus give them a little extra. And so it is still, somewhat tax-free, but it's a little structured a little bit differently than before they're 18.
And I understand that this has got to be tough for you because everything you're talking about is really specific to what's going on. And at the end of the day, somebody needs to look you up and they need to give you all of their situation, and then you can make a very specific strategy for their specific situation. And I appreciate the fact that you're trying to give some information here, and hit all of the high points without going into the weeds on that. And that's very valuable. I'm gonna be thinking about that. Wow, pretty cool. Now, since you're talking about kids and so forth, what is the best, regardless of where I am in my age group? Maybe you're going to tell me it's specific to the situation, but in most situations, what is the best form to put education dollars away for your kids?
So there's not a whole lot of really good ones out there, unfortunately. And so, you've got the 829 plans, only a couple thousand a year. And we know with, college, the expense of college these days, that's not a ton, but that is something you can look at. Now it's only deductible on the state side, and only some states do it. So I'm not a huge fan of the 829B plan, because as I'm an entrepreneur myself, and most entrepreneurs, they want it all, right? We want our money. We don't want to pay taxes. We want control. We want liquidity.
Exactly.
We want it all. And so 829s don't give us liquidity. And especially if you're in a state that doesn't give you a tax break for it anyways, and I think it's just a waste of time. But the 831B strategy, if you're a candidate for it, like I said, you can use that money for whatever you want. So start stashing your college funds there, tax-free. Then we pull it out. 831B, what's kind of cool about it is this is one of the very rare legal ways that we can somewhat double dip. The IRS has plenty of ways they double dip on us. With 831B, so say we put money in, we get the tax break right up front. 10 years go down the road, we need $10,000 for our kids' tuition. We can borrow money out of the 831B, so that's not taxable income to us.
Right.
Add $10,000 to our kid, write it off again, and then our kid pays for their tuition and gets the tuition to pay for their tax.
Now that is a strategy I like.
Yeah.
The double dip, and like you said, the IRS has plenty of double dip opportunities. Oh man, man, that is great stuff. What are the, Chris? What are the biggest changes to the tax code that have happened in 2018? I think that's when Trump really sort of.
That's right.
So what are some of the biggest changes that we should be aware of? We got filing coming up for 2018 pretty quick.
Yeah, absolutely. The absolute biggest one for entrepreneurs, and there's a ton of changes. This is the biggest tax law change since the 80s. And so there's a lot of changes, but the very biggest one I want all entrepreneurs to be aware of, and most of them probably are by now because it's so out there. It's the Section 199A deduction. And what that is say if you're an S corporation, you're getting a W-2 wage, but then you're also going to get a K-1 from your S corp that ends up in personal return, right? Well, that K-1, 20% of it is tax-free. Now, there's an algorithm that goes into it, so it's not a clean, just straight 20%. And then particularly for our service, professional service entrepreneurs, so your dentists, your doctors, accountants, attorneys, they got capped. So if their income is too high, then that 20% fades away and then goes away. And so it's really important to be able to implement some of these strategies we've talked about and others that we can bring your income down on paper enough to qualify for that 199A. We can get an instant 20% tax-free off your K-1. And so some people aren't going to hit over that income limit, which is fine. They'll take advantage of that 199A. But if your K-1 and your W-2 together are 400,000 plus, then you really should be looking at how can I get my income to look less on paper, so then it's just a jump, right, from 0 to now 20% extra tax.
If you're getting caught in some of the jargon here, if you're listening to this, you're going, what is a K-1 and a W-2? If you're an S corp, then chances are good in some cases that you're paying yourself as an employee, so you're receiving a W-2, but then a K-1 would be like a partnership return in the S corp, correct?
Right. So you have your W-2. You're right, exactly right. You're paying yourself as an employee. If you're an S corporation, you should be paying yourself as an employee. So you get a payroll check just like all your other employees do, right? You take that home, you got a W-2 just like anybody else. Most entrepreneurs, and if you're not doing this as an entrepreneur, definitely need to talk about it. Most entrepreneurs, what they personally take home to cover their personal bills is split between the W-2, and then they take what's called distributions, where they just take cash from their business account into their personal account. If you're taking 100% of what you live on from a W-2, we got to talk.
You're right. You're losing money.
Yeah, but so that money that you're taking out from the business to the personal that's not running through your payroll, that plus net profits that are still in your business, that all adds up. It gets put on a form K-1 that's part of your S corporation tax return.
Mm-hmm.
And that K-1, there's a special form on your personal return where that income gets reported, and you personally pay tax on that. And this 190A will allow us to take, structure right, will allow us to take the 20% off of that K-1.
But the important thing is I need to have some of the other strategies in place to be able to make sure that the income that I'm reporting has been maximized in my favor.
Exactly. Yeah.
Okay.
Yeah. So
awesome. Good stuff. I heard a report the other day. If you're listening to this and you're going, man, that sounds great, but what are some things I can learn from Chris if I am if I am not an entrepreneur and I'm listening to this? I want to throw this at you, Chris, totally out of the blue. So I heard a report the other day that there were people somewhere in the U.S. who were upset that they didn't receive as much money back from their tax filing. I'd be happy if I got money back, but my question is, what would you tell the person who's going, I've gotten, X number of dollars back, and this year I'm going to get less. How is that good for me? I thought there were tax cuts, right? Now, I know the answer to this, but explain the logic behind that for somebody who may not understand it.
Yeah, that's a great question. And so there's probably several factors in play, and I get that question asked every time.
Do you really?
Yeah, all the time. And so far this tax season, I've only had one client that with the new tax law changes ended up paying about $500 more in taxes. But everybody else, whether you're an entrepreneur or a W-2, has brought home more. Now, what a common mistake is that people equate their actual refund to what their tax liability is.
Yeah.
Which is two completely different things. And so one of the things that happened at the beginning of last year with the tax law changes is they created a new W-4. And for the W-4 is what you give your boss. It says, okay, I'm single and I want to have 2 withholdings. And then they withhold taxes out of your paycheck. So as people made those adjustments, the whole point of the tax law was to keep more money in your pocket, right? So as you made those changes, it told your employer to withhold less. So you got more money along the way rather than just getting
one lump at the end, right?
Yeah. So if you like to give tax-free loans to the government and get a big refund, that's fine. Some people, do it as a way of forced savings, and there's no judgment in the situation, whatever is right for you to do. But the whole idea was if people have more money in their pocket as you go throughout the year, you can now make smarter decisions of, paying off debt or saving up or, buying an extra car, whatever you want to do with that extra cash.
As you said a moment ago, the idea is that you are smarter with your money than the IRS is with your money.
That's right.
Right.
Absolutely right.
And
there's a few other, oh, sorry.
No, go ahead.
So there's a few other things that could happen. I had a neighbor actually that they never changed their W-4, so they had the same withholdings going, but their son turned a year older and now got out of the child tax credit dropped by $1,500. And so they're like, well, I got, $1,000 less. What's going on? It's like, well, your child got older. Sorry. And that was in the tax code before and after the Trump law. So it's just a matter of, your situation. And there are a few people that will end up paying a little bit more tax. It does happen. That happened to one of my clients so far. But the vast majority is considerably less. I myself, paid $10,000 less in taxes this year because of the tax law changes. And entrepreneurs in general are going to definitely pay less in taxes. If not, you need to come talk to me.
Well, exactly. And let me ask you a question sideways here. What year, when in history did the IRS or the government begin taking taxes? When in history did the employer begin to take taxes from employees' paycheck on behalf of the government, rather than the all of us paying taxes, on a quarterly or yearly basis? Do you know when that happened?
I don't know the exact year. Probably was going to be, early 1900s. That's when the taxes really started coming to play. The government decided they wanted a piece of tobacco and alcohol industries and guns. And so that's where taxes really started. Income taxes, not property taxes. And so it just progressed from there. So probably I would guess you get close to the 1950s is when things really started to do that.
It amazes me how many people never look at their gross wages. Instead, they look at what they take home as being what they've earned. And I think this is one of the biggest challenges, just a personal beef of mine, not to get on a rant here, but I think that this is one of the things that has allowed Americans to be sort of in avoidance mode in terms of the taxes that they pay. They don't even really look at that money that goes out as theirs. They only look at what they take home as theirs. I'm a firm believer that if everybody on earth had to actually physically write a check for their taxes, they'd be much more concerned about how the government spends their money. That's just me.
I 100% agree. And it's interesting when you have somebody that goes from a W-2 job to an entrepreneur, because the entrepreneurs are the ones cutting the checks, right? And it's instant. Their perception changes. You're absolutely right.
Yeah, that's been an amazing scenario. I think that's one of the biggest things that, in my view, that's happened. That's pulling the wool over people's eyes. Just the money's gone out before I get it, therefore it's not really mine.
Yeah. Which is totally untrue. And the tax law doesn't lean towards W-2 people as well as entrepreneurs as far as strategy and being able to reduce that. But there still are opportunities there, and obviously within the entrepreneur world, which we've been talking in depth about today. But yeah, that money, it's yours until you file that tax return and figure out what your liability is. And so, especially if you're overpaying, if you can get that money and stick it in a savings account instead of overpaying, heck, take some responsibility over your own money, your own situation, and you're going to be able to far outdo whatever the government says or doesn't say they can do for you.
It's your money at the end of the day, right?
Right.
I mean, it's your money. Last thing, Chris, one of the biggest changes in my limited understanding is the tax credit. The versus versus being able to what's the word I'm looking for, Mr. Producer? You're not sure where I'm going. See, I talked to somebody super intelligent like Chris, and I realize how stupid I am. Versus being able to deduct or to take deductions. What is the tax credit now that I should be concerned about as a married person that I can claim versus being able to take deductions?
As an entrepreneur,
Mm-hmm.
or just anybody?
Yeah. Is it different?
So there's a lot of little things that are different. And so one of the biggest things that changed.
I'm talking about itemization versus.
Perfect. Okay.
I used the word deductions and I couldn't think of it. I'm talking about itemizing, being able to itemize versus the tax credit that they give you. Is that the right word, tax credit?
That's the standard deduction.
Standard deduction is the word I couldn't think of.
Yeah. So yeah, that was a big change and one that will help a lot of people. So the standard deduction, what that is the government says you can make this much money tax-free. And that's just the standard deduction. Now they also have itemized deductions, which are a few different things: your mortgage interest, your property taxes, donations, charitable donations, couple other small things. Those are the big ones. So if those things add up to more than the standard deduction, then you itemize and you take that deduction. And that's tax-free money that you can make.
And
so
is that standard deduction has gone up now to like 26,000, right? Or
24,000 for married people. Yep, 12,000 for a single person. And then if you're retirement age, it's up to 28,000. And so a lot of people who used to itemize aren't going to anymore, and it's going to work out to their benefit. And so that was a big thing. And so, so that's what you need to look at. Some people make the mistake, especially if they're filing on their own. They'll say, "Oh yeah, I've always itemized, so I'm going to do that," and then they cut themselves short because they miss, potentially $10,000 worth of standard deduction.
Gotcha.
So that was a big change to our benefit.
Awesome. Chris, I tell you what, I wish we had another half day because everything that you were talking about here is super valuable. And if you're listening to this, if you're watching this, and you want to get a hold of Chris Anderson at Soulence, Soulence. So they can find you at soulence.com. Is that the best place?
That's right. Yep. All our contact info is on there. You're welcome to call our office. The phone number's on the website, but we've got a lot of good information on there. We've got some worksheets and different things. We like to educate people as much as possible, whether they use us or not. So you're welcome to utilize any resources on that website, but that's definitely the best way to contact us: email, phone. We've got 4 accountants in the office, all work the same way that I do. We're out here proactively trying to help you save money. But I'm happy to meet with anybody that gives our office a call.
Chris Anderson, thank you so much for all of the advice that you've given us here. I appreciate very much you giving us your time today. And my friend, thank you for what you do for our clients and for all of us here at the Crabtree Group. I appreciate it very much.
You're welcome so much. It's my pleasure. Thank you so much for having me.
Have a good day, my friend. We'll talk again soon. I'd love to do this again.
Absolutely.